guides. Will you recommend the Job Guide 360 interview guide to prospective job seekers?
Sure, I will. The guide is detailed and very comprehensive.
Welcome to the Deep Dive. This is where we take complex source material and, well, rapidly extract the critical knowledge you need. Today, we're opening up the files on the mortgage underwriter role. We've gone through a whole stack of interview guides, hiring insights, basically giving us a kind of cheat sheet on what companies really value, for the person making these huge financial calls. And the sources. They're showing the mortgage landscape is, well, pretty dynamic right now.
It really is.
There's this notable surge in demand for skilled underwriters. It seems driven by, market competition, those shifting regulations.
Exactly. And low interest rates play a part, too.
Right. It's clearly not just about shuffling papers. These are high-stakes, often nuanced decisions.
They absolutely are. And honestly, the underwriter, they're the vital gatekeeper in this whole process.
Gatekeepers, yeah.
Their main job is mitigating risk, ensuring loan quality for the lender. Simple as that. But complex in practice. So by digging into the kinds of questions hiring managers actually ask, we sort of bypass the standard job description. We get straight to understanding the technical know-how, the critical judgment, and the specific soft skills needed to greenlight or decline a loan.
Okay, let's unpack that then. If we're looking at what these companies are focusing on, in their hiring, what are the absolute core things they're zeroing in on?
Well, it really boils down to 3 pillars, I'd say.
Okay.
Deep risk assessment skills, meticulous attention to detail, and that's key, and just really robust analytical capabilities. These skills let them not just, follow rules, but actually anticipate and manage potential future losses.
Okay, let's start with those hard skills, the technical stuff.
Yeah.
If we trace a loan's journey from start to finish through the underwriter's perspective, what's that sequence of checks look like?
Right. So the initial phase is purely focused on the borrower's capacity to repay.
Makes sense.
The underwriter's digging deep into credit reports, employment history, financial docs, all that stuff. Then they shift pretty quickly into risk assessment. And that includes evaluating the collateral, the actual property.
House itself.
Exactly. They're looking very closely at the property appraisal. That's how they calculate the loan-to-value ratio, the LTV.
Okay, hold on, LTV. For someone listening who might need a quick refresher, maybe prepping for a meeting, what exactly is the LTV ratio, and why is it such a big deal for the underwriter?
Good question. Yeah, absolutely. The LTV ratio, it's basically the loan amount compared to the appraised value of the property. Super simple concept.
Okay.
So if a house is valued at, say, $200,000 and the borrower needs a $160,000 loan, the LTV is 80%.
Got it.
A lower LTV means less risk for the lender. Why? Because the borrower has more of their own money, more equity tied up in the home. It's a really fundamental risk metric.
Right, more skin in the game. So that initial check on the borrower's creditworthiness, that's obviously foundational. But beyond just a good score, what's the underwriter really looking for? Are they just searching for green lights, or are they actively hunting for potential red flags?
Oh, they're definitely hunting for red flags. I mean, they do a deep analysis, calculating the classic debt-to-income ratio, the DTI, of course. But they're also looking for what we call compensating factors.
Compensating factor.
Yeah. Things that might balance out a slightly higher risk profile. Maybe the borrower has really strong financial reserves, like significant savings. Or perhaps they have a long, stable history in the same line of work, even if they just got a promotion. It's more of a holistic view, really. Can this borrower actually weather a financial storm if one comes along?
That's interesting. It sounds like numbers, but you mentioned compliance running alongside all this. Is compliance genuinely zero tolerance? Or is there some wiggle room, maybe internal metrics allowing for small justifiable deviations?
Compliance.
Yeah.
Yeah, it's like a constant shadow over everything. The rules are extensive, complex. MEOs have to stay constantly updated. Federal, state, local regs. It's a lot.
Wow.
The zero tolerance part isn't so much about tiny deviations, perhaps, but it is about the audit trail.
The paper trail.
Exactly. A huge part of the job is keeping meticulous, detailed records.
Yeah.
Why? To prove the decision was compliant. Every single step. If that documentation isn't watertight, the decision is just vulnerable. Doesn't matter if it was the right call.
And those rules, they aren't one size fits all, right? You mentioned different loan types earlier.
Precisely. They need fluency in program-specific guidelines. You've got conventional loans. They follow Fannie Mae or Freddie Mac standards. Those tend to be pretty strict.
Okay.
But then you might be looking at an FHA loan. That has its own requirements for loan limits, mortgage insurance, designed to help borrowers with lower down payments because it's government insured.
Right. Different risk profile.
Totally different. And VA loans, that's another world altogether. Focused on veteran-specific eligibility and entitlement, so the underwriter has to be able to switch gears instantly depending on the program.
That all sounds so technical, almost formulaic.
Oh.
But if the rules are often quite clear, why does it feel like the judgment part is the trickiest bit?
Because people's financial lives rarely fit neatly into those standard boxes, you know? And that takes us right into the, let's say, the behavioral side, the personality demands, managing complexity, handling pressure. MUs are juggling a high volume of files. They have to prioritize constantly. Urgency, complexity. They need to figure out which files are straightforward, maybe use automation tools for those repetitive tasks.
Right. Triage.
And save their real brain power for the tough ones, the gray area cases. That's where the judgment really comes in.
That kind of high-volume pressure cooker environment must demand intense focus. Tell us about that attention to detail. The source material had a great example, didn't it? An underwriter spotting a tiny error that turned out to be significant.
Yeah, that was a perfect case study. The underwriter spotted this discrepancy. The income on the tax returns just didn't quite line up with the borrower's other financial documents. So through really careful cross-referencing, they found a subtle error in the actual tax calculation. Not fraud, just an error. Now, the crucial part. The response wasn't just decline. It was clear professional communication. Reaching out, requesting amended, correct documents, that level of detail. It saved a lender from a potential problem down the road, and it was fair to the borrower.
That's impressive.
Yeah.
But wouldn't digging that deep slow things down quite a bit? Is there pressure, maybe from loan officers or managers, to just push files through faster, even the complex ones?
Oh, there's always pressure. Always. And that's exactly why the exception process is so vital.
The exception.
Yeah. Remember that example of the borrower who'd recently changed jobs?
I do.
Standard guidelines often flag that, right? Potential income instability. But a skilled MU, instead of just saying no, they dig deeper. They ask for specific documents, the offer letter, the employment contract. They might even look at industry trends to confirm, yes, this income looks stable, maybe even growing.
So they're essentially building a case, a logical, evidence-based story to justify overriding what looks like a technical red flag.
Precisely. You nailed it. And that story, that evidence, that becomes the exception memo.
Okay. For really complex situations, multiple income streams, maybe unusual assets the MU has to consult the guidelines, do thorough research, and then write up this detailed, objective justification for why they're deviating from the standard path. That detailed paper trail isn't just CYA, it's proof of sound professional judgment. Which brings us beyond just the technical skills, really, into the personality needed for this job. Communication, managing relationships. The underwriter is definitely not working in a vacuum.
No, absolutely not. They're constantly interacting with loan officers, right? Asking for more documents, sometimes pushing back against maybe overly optimistic views. And they deal with external folks too, appraisers, title companies. How do they navigate all that potential friction?
The key seems to be proactive, really clear communication, and setting firm expectations from the start.
Look, loan officers often want that, yes, fast. But the underwriter has to maintain their independence. They need to explain why certain documents are needed, especially for tricky things like self-employment income. Using precise professional language helps minimize that back and forth and keeps things trusting.
Okay, here's what feels like the real core challenge, maybe the nugget of the role. Balancing empathy and objectivity. How on earth does an underwriter manage compassion for someone's situation, often stressful, unique situations, while sticking rigidly to lending guidelines?
Yeah, this is absolutely where the difference between a good MU and a great one shows up. The source material really emphasizes this. MUs should recognize unique challenges with empathy. They're human.
Right.
However, and this is the big however, objectivity and fairness have to win out, always. They use sound judgment to consider those extenuating circumstances, sure, but only within the framework of the policy. Their ultimate duty is protecting the lender, yes, but also ensuring fairness to all applicants. Personal feelings can't override careful risk management. Objectivity isn't being cold, it's professional accountability.
And those policy frameworks, they're not static, are they? We see updates all the time. DTI ratios change, down payment rules shift, so adaptability must be completely non-negotiable.
Absolutely non-negotiable. They have to be proactive about researching every single change, attending mandatory training, and crucially, being comfortable asking for help. Seeking guidance from senior underwriters or compliance folks when a new rule creates some ambiguity. It really is a commitment to lifelong learning in this field.
Given all this complexity, this blend of skills, hiring must be tough. How are companies getting better at identifying the right people, moving beyond just resumes and standard interviews?
They're leaning heavily on standardized objective skill assessments.
Okay.
These tools help strip away bias and actually verify if candidates have the core competencies that matter on the job. They're looking for applied knowledge, not just textbook answers.
Makes sense. What kind of assessment tools are they actually using?
We see several key types mentioned. First, you've got underwriting case studies.
Right, simulations.
Yeah, exactly. They test risk evaluation, applying guidelines in realistic scenarios. Really test that judgment piece we talked about. Second, knowledge-based assessments. These make sure the technical fluency is there. Regulations, loan products,
Got it.
Third, critical thinking and problem-solving tests. Can they analyze those complex gray area situations and propose solid, justified solutions?
And presumably they need to test those crucial soft skills too.
Precisely. So you see, attention to detail assessments. These check for thoroughness, spotting discrepancies, accurate data entry, often under time pressure, and critically, communication assessments. Can the candidate clearly and concisely explain a complex decision, an approval or a denial to different people? That ability to communicate effectively is huge for minimizing friction. So if we synthesize this whole deep dive, the mortgage underwriter role really demands like two brains working together perfectly.
Yeah.
You've got the technical brain mastering FHA, VA, DTI rules, all that. And then the behavioral brain managing the pressure, the interpersonal stuff, and maybe most importantly, justifying those necessary exceptions using solid professional judgment.
So wrapping this up, what does this mean for you, our listener? I think the key takeaway is that in a field like this, high stakes, heavily regulated success isn't just about following the rules to the letter.
Right.
It's about the justified application, the professional judgment, when the rules maybe don't cover everything perfectly. That human element, as long as it's backed by solid documentation, seems to be the most valuable part.
And that really raises a final provocative question for you to think about. Imagine you were an underwriter. Your gut says approve a loan, but it's borderline. It needs an exception. What single piece of objective data, something beyond the standard stuff, would you absolutely insist on having in that exception memo to feel confident, to guarantee your fairness and protect your own professional accountability?
That level of justified discretion.
Yeah.
Yeah, definitely something worth pondering. That's all the time we have for this deep dive. Thanks for tuning in.